Wow, it's bright up here. So let me introduce our panel and we'll jump right in. We have the SPAC panel here, when SPACs have been referred to a few times in some other panels, so we're going to dive into it in more detail here. To my left, I have Emily Roberts, who's a longtime partner at Davis Polk. To my further left, we have Usha Rodrigues, who's a professor at the University of Georgia. And at the end, we have Steve Fletcher, who's a longtime banker and now current CEO of Explorer Acquisitions, which is a multi-SPAC platform. So to jump right into it, given a lot of the SPAC talk we've had today, I thought I'd start with Steve to give us sort of an update on what he's seen in the marketplace for SPAC IPOs.
All right, thanks so much, Ross. So it's very interesting that I started in the SPAC business 4 years ago, and at that time, nobody had ever heard of a SPAC. What's a SPAC? Every meeting I went to, it was a missionary meeting. What is a SPAC? How does it work? And we went from years of 3 or 4 dozen SPAC IPOs a year to now 500 SPAC IPOs in a year. And so the market has absolutely exploded, and it's gone from being a backwater to a very popular and I would argue important part of the market now. We saw a real lull in the market in the middle of this year. One, the SEC put the brakes on IPOs in a not in a explicit fashion, but in an implicit fashion, and it also became an area where it was more difficult to do IPOs. The capital providers for SPAC IPOs tend to be 75-80% event-driven hedge funds, and with 25-30% being traditional mutual fund and long-only investors. And they had some indigestion with SPACs. We've now moved to a place where it's much more expensive for sponsors to issue SPAC IPOs, but the volume has returned, and the SPAC IPO purchasers have returned. So we're now back to a place where I would actually say, probably too many SPAC IPOs, where we went from, as I say, 2, 3, 4 dozen a year, all the way up to we had 100 a month in the first quarter of the year, which I would argue is too many, and we're now on a pace to do more than 50 a month right now, and I think that's probably a little bit too high. That's where we are.
And so, Emily, I know I think your focus of your practice is not on the SPAC IPO, but on the de-SPAC transactions. And curious what you're seeing kind of in the volume of those, but also maybe how terms have changed, both as private companies negotiate with SPACs, but also as the SPACs and the private companies together negotiate with the pipe market.
Yeah. So I think when the market was pretty frothy earlier this year, there were a lot of SPAC IPOs, but there were also a lot of de-SPACs getting done, and the velocity of the pipe fundraising was quite elevated. I think that, so just to take a step back, a lot of SPAC post de-SPAC, and de-SPAC of course is the transaction where the SPAC merges with that operating company, closes, and then it continues as a publicly traded company. So a lot of those de-SPACed companies have traded down, and I think that's given pipe investors, and that plus with the SEC issue that Steve mentioned, made people take a little bit of a step back and think we need to be a little bit more prudent about valuation, about who the sponsor is, take a look, maybe testing. So, but those deals, so they really slowed down a little bit. There were deals that were not getting done because the pipe couldn't be raised at the valuation that the sponsor had promised the target company. I think those deals are getting done more, but people are a little bit more cautious on valuation than maybe they were in February.
Gotcha. All right, and are you seeing any particular terms sort of change over the last little bit vis-a-vis the pipe that were different, or people moving to more structured products versus common pipes, or just curious about that, what you're seeing?
I personally haven't seen a lot of the terms change other than the value, but it is very specific, it's very, very specific to what that SPAC is, what that target company, what the target company's capital structure is, what the pipe raise is relative to the
Gotcha.
total valuation.
And so Usha, as an academic and someone who has studied this product in the markets for a longer period of time, given what you're hearing both Emily and Steve talk about the market now and over the last 2 years, I'd be curious if you could put this in kind of a little bit more of a historical perspective for us about how, where we are now versus where we've been over a longer period of time.
Sure, Ross. So it's funny to hear you talk about SPACs as a backwater 4 years ago, because I started studying them 10 years ago. And nobody really knew that there were SPACs 10 years ago, and I described them as a backwater. And we've come a long way, and they have evolved quite a bit. One of the exciting things for an academic researcher about SPACs is that it exposes all these things that are public that we don't normally see, right? Like we get to see capital raising in a way that's somewhat parallel to an IPO, but that's a black box, right? We don't really have a lot of data to study. So with SPACs, you can see this rapid evolution over time. And we have seen, this is probably the third or fourth generation, actually, of SPACs that we've seen. We've seen them migrate from this kind of, just one step up from penny stocks, trading on the over-the-counter markets, and the pink sheets, to moving to, big investment, bulge bracket investment banks, and the NASDAQ, the New York Stock Exchange. And we've seen their terms evolve. I can talk a little bit about that later, because I did 2 studies back in 2010, and now have one on the more recent generation of SPACs. And there's a lot of data, and I think they show a lot of really interesting things.
Do you want to start with something that piques your interest? Like what the...
Sure, this might bring some controversy early on to our panel. But the SPACs sort of conceptually makes a lot of sense. It gets complicated, but conceptually it's you raise a bunch of money, and then you give the management 2 years or 18 months to go find a target. And if they don't find a target in that time, then the public gets its money back, right? Or the SPAC shareholders get their money back, customarily $10 a share. And so, and the sponsors only get a payout, of course, if and when they successfully close a deal, de-SPAC. Good. So originally, the SPAC said there was a threshold set. If more than 20% of the shareholders redeem their shares when it's time for the de-SPAC, if they take a look at the proposed target and they say, I'm out, more than 20% ask for their money back, then the deal doesn't close, because there's not enough money to fund the transaction. Along comes 2008, and this is right in the middle of our first data set. Along comes 2008, and all these hedge funds start holding up deals and basically green-mailing the SPACs. So the conversion thresholds go away, and the SEC lets the conversion thresholds go away. And what that means then is that redemption number can float up, which is kind of a problem, because now you don't know how much money you're going to have when you're negotiating with the target. Enter the pipe, right? And so our data looks at, among other things, these things can be very thinly traded. We have data on the liquidity of SPACs. We have data on the extent to which they miss some of their public filings that they're supposed to make, like their 10Qs and their 10Ks. And we also have data on correlations between the rate of redemption, the level of redemption, and how well the de-SPACed company does post-de-SPAC. And the correlation we find is indeed a negative one. So if there's more redemptions, then even 10 days out of trading, the SPAC will statistically trade down, comparatively down. And so I'm a good academic. I have a policy prescription, but it might not go be too popular on this panel. The prescription is that if more than 50% of the shares are redeemed, then the deal shouldn't go forward.
Gotcha. Well, so we can dive into that maybe a little bit towards the end. I think it may be helpful, given the audience here, probably there are a bunch of people that work at public companies, but a fair amount of people that work at private companies, to talk a little bit about why it is that a SPAC might be a good vehicle, as one of the earlier panels talked about, not as an alternative to M&A, but as a fundraising, maybe an alternative to a growth equity round, or alternative to an IPO or a direct listing. So maybe Steve and Emily can talk in any order you all want about sort of what you're seeing and why you guys think the SPAC product might work for a certain kind of company.
Sure, I'm happy to go first. So I think there's a couple of structural advantages to a SPAC versus a traditional IPO. One, it tends to be a little quicker. That's not statutorily, but it typically works out to be about a 6-month process as opposed to an IPO. It tends to be a 12 to 18-month process. There is an opportunity for a significant amount of secondary proceeds for the existing owner of the company, which is atypical in an IPO. And then most importantly, our belief is that the SPAC sponsor should really add a lot of value to the company post-transaction. And as we think about our SPACs, we don't just think about them as a transaction, we really think about them as a partnership between the company that's going to be newly public and our SPAC and our team. And there are many, many very talented entrepreneurs who run companies and have grown private companies very successfully. But the transition from being a private company to a public company is a really challenging one. And figuring out how to manage the street, how to think about stable cash flow and earnings, how to think about strategy long-term while still maintaining quarterly earnings. There's all sorts of things that are more difficult and more complicated in the public company context. And we try to match our management teams who are very experienced CEOs, and certainly other SPAC sponsors do other similar things, not all, but many. We try and match our very experienced public company CEOs with these talented entrepreneurs to help the company thrive afterwards. And so for a company that could use some of that mentorship, we think the SPAC, where that happens, is a very appealing process. And then I guess I would just note lastly, because in a traditional IPO roadshow, it's a very, very accelerated process. Companies typically have 30 minutes to tell their story to the investor, whereas in a SPAC, you can have a much longer time to tell the story, whether it be an hour or an hour and a half in a meeting as opposed to 30 minutes, or that the de-SPAC process extends over a couple of months, and investors can really take a deep look before the company is fully public. If a company has a story to tell that's not so straightforward, it's not just straight up, we believe that the SPAC provides a really good context for that.
Emily, would you like to?
Sure. I warned Ross I was going to take a little bit of the other side, because I do think that the IPO is a great product too. For companies that are looking to become a public company, for a lot of companies, the right path is just a traditional IPO, and the SPAC market has been on fire this year, but the IPO market has also been on fire, and I think a lot of people would think of the IPO as maybe the advantages would be a simpler process because you're not doing a business combination at the same time as you're doing a going public transaction and a listing. There's also sort of you kind of get a little bit of more of like a ramp to that public marketing process at the end, instead of the SPAC process really front loads a lot of that work. You announce your deal and you describe your company to the public markets at the very beginning of that, say 4 to 6 month process, which means that you kind of got to be ready to go at the outset. I think that I think a lot of people have pointed out the negatives about SPACs. I would say that I think it is the right option for a lot of companies, and I'd say companies that have some sort of like you said, companies that have some sort of difficult, more complex story to tell, where a credible sponsor is really going to make a difference for how that story gets interpreted and valued by the market. That might be one that, there's a little more flexibility in the way the story gets told in that couple months run up between the announcement of the deal to the closing, where you can get your message out. And I think that one of the other things that people don't talk about is, IPOs get their place to those large investors primarily. A SPAC, there are a lot of companies that have been taking their story to retail more, and for some companies that's an advantage. on this background.
Interestingly to me, neither of you guys talked about sort of a mispricing of traditional IPOs. And you know, when you see the 300% spike or whatnot, you know, you may have a better sense of getting the valuation right if you're doing a negotiation versus the black box as you talked about. But we'll leave that. On everything, you know, the SPAC market has appeared to be a place where regulators are spending more and more time and more focus, and clearly plaintiffs are spending more and more time there as well. Usha, do you have a view of sort of where you think regulators may be spending their time going forward, and how they may, above and beyond your prescription vis-a-vis the 50%, but that plus anything else that you think they may be focusing on?
I think that the SEC, I mean, it's on the regulatory agenda for this spring this year that rules are coming in early 2022. I think they'll take a look at redemption. I think there is this litigation involving something we haven't discussed yet, that I sort of alluded to. There's this pressure, you know, towards the end of the time period. If the clock's ticking on the SPAC, and at 18 or 24 months, we see that SPACs can get kind of desperate for a deal around that time, right? Or ask for an extension. And there's litigation on that front. There's litigation suggesting that SPACs should not be regulated as investment under the Investment Company Act of 40 after 12 months, right? So I think that is certainly something that's on the table, is looking at maybe not that regulation, but certainly looking at SPACs who are getting towards the end of towards their expiration date. So it's definitely, I expect regulation to come. Those are some fronts where I see it.
Do you think some of the places where the regulators have actually focused their attention, like warrants and accounting, are places where they should be, or those are kind of like red herrings to stop, to slow down the marketplace without really a lot of substance behind some of those things?
Well, I don't think they're red herrings. They certainly do have an effect on the market, as we saw in the spring. I think they are, you know, shots across the bow that sort of are that tried to cool down a perhaps overheated market, and indeed did so. But I think that they're looking; those were sort of stopgap measures in advance of the more formal rulemaking process that I think is coming. And of course, I didn't state the obvious one, which is disclosure, right? There's already now more scrutiny of the disclosures that are coming both in the IPO stage and in the de-SPAC stage. That's just in the toolkit for the regulators, and will continue to be so.
Emily, what are you seeing? And what? Oh, sorry, Steve, go on.
I was just going to say, one thing that you didn't mention, which I see out there as a potential regulatory consideration, is traditional IPOs. There's not a safe harbor rule for using projections, but in SPACs there is a safe harbor. And that creates an uneven playing field, and I think there's going to be some rules to even that playing field.
I agree.
Yeah. I think the SEC is also going to be focusing on internal controls. Like, you know, I think from their vantage point, and there's a ton of companies that have gone public via SPAC, and I think that, you know, they're saying, are these companies, you know, do they have it? Are their internal controls sufficient to ensure that, you know, there's no fraud, that there's, you know, that their financial statements are well done, that they're in compliance. So I think that's going to be something that they're going to be focused on as well.
As we think about, as maybe practitioners in this marketplace, putting aside additional regulation or litigation, are there things that people in the marketplace you think should be doing, whether it's, you know, traditionally de-SPACs maybe didn't have a fairness opinion? Should there be things that people should be looking at, or thinking about ways that even as practitioners we should be thinking about how do we make this market more, I don't know, secure is not the quite word, but I think you understand the question I'm asking.
Yeah, I mean, I think going back to this internal control thing, I think that all of us SPAC practitioners need to bring to bear like the full, as you know, counsel to a target company. We should be, you know, doing the full suite of diligence support, for example, that we do in an underwritten IPO. And for the, I think another thing the SEC has raised and brought enforcement actions against is does the SPAC board, have they done their diligence on the target? Have they actually, kicked the tires and made sure that this is that the company is what it says it is? I think that those sorts of things are things that, there's always going to be, just the same as IPO companies, there are always going to be some companies out there that turn out to be kind of a rotten egg. But, how do we make sure how do we put in place processes that are designed to help companies, put their best foot forward? Because a lot of times these are not companies that have had a 12-month IPO readiness process in place. They're companies where the executives don't have any public company experience, and so it just takes a little bit of more time and honestly, good advisors to help bring them up to speed.
But Ross, I have a question, because the issue it's not that SPAC boards don't want to get fairness opinions; it's that the bulge bracket investment banks will give the fairness opinions. So do you think there's any pressure on the banks to do that? Do you think they're likely to start doing that in the future?
My guess is the bulge bracket banks will struggle with that, and there will be certain banks that will do that. That would be my guess in that world. But you as a academic, I don't know if you're seeing that, what you're seeing in the marketplace or studying, but like everything else, it would surprise me if certain banks did this, and it would shock me if certain banks didn't do it.
Well, you can get an opinion from Houlihan, but you can't get an opinion from Morgan Stanley.
You just put names to what I just said, I think. Right.
And if you retain Morgan Stanley in your SPAC IPO, you want Morgan Stanley to do the acquisition and advise you, and then you're sort of stuck.
Right.
Well, Morgan Stanley's going to do it because they've deferred part of their compensation. They want to get the deal done.
But they won't get the first.
Yeah.
And then they're in a tough position because if they've got contingent compensation, then they can't give a fairness opinion.
That's exactly right. So you've got a bunch of different issues. So you have to potentially bring in other banks.
Another bank. Yeah,
That's
you could
right.
do it another bank.
That's right.
Yeah.
Usha, are you seeing things, I guess, if you had to look forward, crystal ball, 24 months, 36 months, how do you think, through this administration, at least, what do you think the future holds here?
So I'm an academic, and I don't do crystal balls. And in fact, what's funny about
Wait a second.
So the data are necessarily 2 years back looking. Like right now, we're just starting to look at the 2019 IPO SPACs because we want to see them through their full life cycle. So they're just now getting to it in 2021. I am waiting with bated breath. I do think, so in response to your, the SEC is going to make some moves, and I think we covered pretty well with Steve reminding me about the forward-looking statements. I think that's some combination of that is what I see in the horizon. But there is this ticking time bomb, like taking away the regulators, right? There are just a lot of SPACs out there, and they need to do a deal or their sponsors are going to go home hungry. And so, and if there's a SPAC off with lots of different SPACs who are competing for the same company, are we going to see a race to the bottom? Again, this is just in terms of market forces, let alone the regulatory. So that's something that I'm really interested to see how it plays out. You probably are too.
Very much so.
Just to push back on that a little bit, isn't a race to the bottom really, doesn't that benefit, target companies that are wanting to go public because they'll get, better terms?
Maybe, but this is some of the tension, right? Like it's a race to the bottom in that they're better and better terms for the target company, but maybe that company isn't ready to be public yet, right? And maybe we're seeing a version of the WeWork story where the founder has big ideas about how, he's ready to play with the big boys, and maybe they're not. And it's interesting that, people have, in the prior panels have said, well, this will work itself out, right? And that they'll get acquired and there's more companies in the public markets, but there is collateral damage there, which are the shareholders who wind up with stock that goes down because they weren't ready.
Steve, you want to?
Yeah, certainly there are many companies that aren't ready, but I actually think Wall Street is creating a big portion of this problem of the stocks going down because now almost every company that goes public through a SPAC hires an investment bank to represent them just as they would in an IPO. But in an IPO, there's a lot of tension built in between the equity side of the investment bank and the investment banking side, where one side wants to have a lower valuation, one side wants to have a higher valuation, and they end up at some appropriate valuation. And when a company hires an investment bank to represent them for a SPAC process, that investment bank always assigns the M&A team to the project. And if there's one thing that sell-side M&A bankers are good at, it's driving the price up. And when you've got competition amongst many different SPACs who are hungry to do a deal, when you've got bankers that are saying, well, you got to pay this price to get it done, that's the definition of competition, is paying a higher price. But at the end of the day, the company may not be worth that price. And so you end up with a stock that, to Usha's point, may decline. It may not be because of the performance of the company. It may just be because they were overpriced at the time of the de-SPAC. And so it's interesting. People think IPOs are perfect. In fact, 50% of IPOs trade below IPO price a year or two after the transaction. Usha has forgotten a lot more about the price performance of SPACs than the rest of us in this room will ever know. But if you take out some of the outliers, it's not vastly different than the IPO performance. But I do think this negative performance is being exacerbated by Wall Street's methodology right now.
So we only have a couple minutes, and because we're at a lawyers symposium, I'm curious if Emily, you maybe want to give a little advice to in-house counsel about if they're going through a SPAC process. What are things for them to be concerned about, and maybe for outside counsel as well?
Yeah, I think I touched on this earlier, but a de-SPAC process is it's a complicated, messy transaction. You're in the middle of, it's a very compressed timetable for taking a private company that may not have been previously thinking about becoming a public company to a company that's under the spotlight very, very quickly. And in order to do that, I think you have to have everything, but more, experience, credibility, issue spotting ability. It's also a structure, and we didn't really touch on this, but SPACs, former SPACs they're kind of second-class citizens in the SEC reporting world, and so there's a lot more there's a little bit more regulatory hoops to jump through as a former SPAC, and that requires it requires more time from the legal team. So it's just like everyone else is. Yeah.
Usha, when you study historically the SPACs, have you seen anything that jumps out to you about sort of legal practitioners in those studies that would be good for the audience to hear?
I'll sound a cautionary note in that because they were a backwater for a while, and there was a sense in which, especially the S1s were kind of cookie cutter, right? Like they were pretty, and that was part of the appeal. It was a standard form, and you could do these deals fast. That maybe there was some sloppiness, and that cannot be the case now. They are definitely being scrutinized by the regulators, both on the S1 side and on the de-SPAC. It's like I've assigned you these parts now. But on both sides, there's a lot more scrutiny. So whereas it might seem like it was an M&A light sort of transaction, that's definitely not the case now, if there was that feeling before. And then also, I would say, what we've seen in our data are that you have to file the 10Ks and the 10Qs. You have to have timely filings when you're a SPAC before the announcement. You're still a public company. And the fact that so many of them in our sample, it is the bottom quartile of our sample, can't manage to get a 10Q when there's not an operating company. What do you have to disclose? Why is it late? It is troubling to me as an academic, and something that I think should definitely be looked at.
And Steve, as a large consumer of legal services, maybe you have some advice for folks here about what both from your investment banking days and now this job, what makes for a good good counsel from your perspective?
Well, I think you used the word appropriately, counsel. So, I think any firm can do the dotting of the I's and crossing of the T's, and that's very important. To Usha's point, that and Emily's point as well, you got to get the filings in on a timely basis. You've got to make sure everything is accurate. But somebody who can give thoughtful, reasoned advice on how, what, and why something is being done or should be considered to be done, to me is worth a lot more than just the ticking and tying of everything in the legal documents.
And with that, I think we have come to the end of our time. So thank you, everybody.